Top Picks is brought to you by Quest Trade, where you can trade stocks for $4.95.
Lorne Steinberg's Top Picks. Cash, that's your number one favorite right now.
Andrew, this market's had an amazing run after the '08 debacle. And we look around the world and everything you're reading about, from record high government debts, which are climbing, governments being forced to do the only thing they can, raise taxes and cut spending, which means slower growth. At the same time, high energy prices, high food prices, higher inflation.
Quite a combo.
Central banks are going to be forced to raise interest rates, and interest rates are the enemy of rising asset prices. And so we're looking for us the obvious, which is going to be a declining stock market, declining real estate prices, and the only investors who are going to benefit from that are those that hold cash.
Yeah, because we've got governments that have been stepping on the gas with low interest rates and stimulus programs, and now they've got to start doing exactly the opposite, jamming on the brakes.
Exactly, and you know, the whole problem that led to the dot-com situation and the home price collapse was artificially low interest rates as central banks kept rates artificially low to prop up the economy. Those things always end badly, and it will end badly this time. We're not predicting something like we saw in '08, but could we see a 20 to 30% correction? Absolutely, we could. And for us, that will be the opportunity, because we're also, quite frankly, looking for a slower economy.
So paper assets, that's where the low interest rate money has gone, essentially.
Everybody is going to the bank, not wanting to get 1% on their money, and buying riskier assets.
What about high yield bonds? What's your feeling?
Our feeling, high yield bonds are a great place to be, as long as you're not going too far out. So in our high yield bond portfolio, we're really focused on the 2 to 5 year range. So we're not going to get badly hurt by rising interest rates, and you're still able to pick up, let's say, anywhere from 3 to 6% higher rates than you'd get elsewhere.
Let's get to your second pick, Novartis, drug giant. Why do you like these guys?
Novartis is a Swiss-based pharmaceutical company, suffering like everybody else is a little bit from patent expiry, but Novartis has probably the best pipeline in the entire industry. And there's also three legs to the company. There's the pharmaceuticals and vaccines. There's the generic side to Novartis, which is Sandoz, and generics are what's gaining when the pharmaceuticals lose the patent expiry. And then their fastest growing division is Alcon, which is an eye care business. And that makes all kinds of things for glaucoma and cataract surgery, both the drugs, the equipment. That's one of the fastest growing parts of the business as the population ages. And people that you may know in their 70s and 80s, everybody's getting cataract surgery. And so put all that package together. Novartis just raised its dividend for the 14th consecutive year at this price yielding over 4%. They're going to have rising revenues and rising earnings, unlike almost everyone in the industry over the next 5 years, and trading for a really relatively cheap valuation of 12 or 13 times earnings.
And a dividend yield of almost 4%.
Over 4% now. Yeah, absolutely. And that will continue to grow as they just throw off tons of free cash flow with an incredibly conservative balance sheet.
You've got a Japanese stock for us, Sanyo Engineering.
Andrew, for us, as I mentioned last time as well, the Japanese market has been so out of favor for so long. Here's the story on Sanyo Engineering. A $90 million market cap, zero debt, $150 million of cash. So even if there were no company here, we're buying $150 million of cash for $90 million.
Wow.
However, we get a great engineering and construction business, which will be a huge beneficiary of this horrible catastrophe that we've witnessed. They are involved in putting up electrical facilities, water treatment, ventilation in new construction. And so they're already, they're going to be right there for the next many number of years.
They'll be turning away work.
Absolutely. And they're also paying a 3.5% dividend.
That one only trades in Japan, though. You can't pick up an ATR.
It only trades on Tokyo Exchange.
Excuse me. Sun Life Financial, you talked about this before. You like it because they didn't dilute the heck out of shareholders.
Exactly. Sun Life, as I mentioned, was the only company which didn't have to cut its dividend or raise any equity. And so here they are. Sun Life will have growing dividends over the next several years. They've taken advantage of the financial collapse, making several acquisitions. They've got a great presence in India, where they are the largest foreign insurer in India, and that market is just growing like gangbusters.
In similar vein, ING Group, the big Dutch financial supermarket.
ING, which did get itself in trouble during the financial collapse, ING is going to have a major transaction happening either this year or next. They will be spinning off either to shareholders or in an IPO. There are two global insurance operations, one in the US and one in Europe. ING is trading for less than book value. Their banking operations are extremely strong. They've also announced that ING Direct, if they got the right price for it, they might sell that as well. And I mean, for us, the breakup value of this company is $25.
And then finally, Futaba, another Japanese stock that was a past pick, but only in January, down since. But
yeah,
short
actually, probably down marginally since. Futaba remains a great engineering business, a global business in so many countries. Japan is but one part of who they are, and they're a fantastic company with a great dividend and actually for us rising earnings next year.
Well, let's squeeze in another caller with a great question. Fred in Oshawa, fire ahead.
Hello, gentlemen. How are you today?
Very good, thanks.
Good. Okay, I am retired, and I'm looking at trying to rebuild my portfolio after the recession.
Okay, we'll have to hurry a bit there, Fred, because we're tight on time. Go ahead.
Okay. What I'm looking at is investing in Bombardier. I see that they just went into China. Mm-hmm. And I'm just wondering if they could get back to their pre-recession dollars and where they were before, and if this is a good investment or if there's something better to get into.
Thanks a lot, Fred.
Thank you.
Thanks, Fred. Well, first of all, Bombardier was a stock in the mid-20s back in the day that had terrible balance sheet problems. They make private jets, various different kinds of airplanes, and other transportation equipment. Bombardier falls in the category of somewhat of a risky stock. They've always had a lot of debt. They're dual-class share structure. So the shareholders don't have a vote. The family has the vote. And that's caused some issues in the past, and some board members resigned over that several years ago. Listen, Bombardier is a very, very cyclical business. When airplane sales are strong, the company does well. But for us, is this a place to rebuild a portfolio?
Thanks very much indeed.
Andrew, thanks so much for having me. Really a pleasure to be here.
Thanks. Lorne Steinberg, Lorne Steinberg Wealth Management Incorporated. We're out of time. Remember, consult a qualified advisor before making financial decisions. Thanks very much. Have a great weekend, everybody, a wild weekend. And we'll be back on Monday at 1:30 Eastern. Thanks for watching.